The indirect method is a way where we start with our income and then we make adjustments to go back to cash basis. And so what we'll do is we'll start with our net income. This is from the income statement. And then we'll reverse all of our accruals. So for example, if we increased accounts receivable, that's an accrual, right? So we debit accounts receivable, credit revenue. Because there's no cash in that, we would then decrease our cash flow for that amount. So if we had $20,000, an increase of $20,000 in accounts receivable, we would then decrease it on our statement of cash flows because there's no cash there. And so we could look at any entry and say, was there cash in this transaction? And then make an adjustment to in our account based on each line item in order to get back to our cash flow from operating activities. So what they're doing here is if we increased our accounts receivable, since that's non-cash, right, debit accounts receivable, credit sales, we would then reduce the accounts receivable, the cash flows from accounts receivable because we didn't get that cash. Increase in merchandise inventory. If we increased our inventory, then we would decrease our cash. We paid cash for that inventory. If we increased our prepaid expense, we paid cash for that. So we decrease our cash. So all these are ways to decrease cash that we paid, but wasn't in our income statement. So we're trying to reconcile net income to our net cash flows for operating activities. And so really we're comparing the balance sheets. We'll say, I think this is one of the better illustrations. Cash here, we know it's 2014 and 2015. Cash increased by $5,000 for the company. We need to know why that cash increased. That cash increased because accounts receivable increased, right? There's a $20,000 increase, which means that we should decrease our indirect method. Oh, we should have had an indirect over here. Our inventory increased, our prepaid expenses increased. So this is always going to be our first step, is just to find the differences. What happened on our balance sheet? What increased? What decreased? Our plant, property, and equipment increased, our accumulated depreciation increased, and so on and so forth. So we'd go through and make all of these calculations. So then we're going to take our net income and add back non-cash expenses such as depreciation and amortization, add back losses, and then add decreases in current assets and add increases in current liabilities. We'll subtract gains, increases in current assets, and decreases in current liabilities. So there's really two ways you can learn statement of cash flows. I'm not going to expect you to prepare the statement of cash flows, right? And it's going to require a lot of practice on your end in your homework. But there's two ways. There's memorization and then there's understanding. And so I think what most people will start to do is with memorization, is because the understanding can be very complex. So from a memorization standpoint, you can remember any additions to current assets will be subtracted from our operating activities. So it's always the reverse. And any additions from liabilities will be added to our statement of operating activities for the current side of things. The reason to that, so that's the memorization. And that's what this formula is. You can flashcard this if the understanding may be too complex this early on in your accounting education. You can flashcard what we add back from in the operating activities and what we subtract. The understanding is because this accounts receivable, theoretically, if we add the accounts receivable, we've increased accounts receivable, we didn't receive cash for that accounts receivable. That's the reason it's increased in the books, right? We debited accounts receivable, credited revenue. There was no cash there. And so we should remove it from our operating activities when reconciling to net income because we never received cash. That's the reasoning, and we can go in each financial statement line item and discuss why that makes sense. But that's the logic behind this memorization, where we would add back non-cash expenses such as depreciation. That makes sense. Depreciation, we didn't pay cash for that, right? Depreciation expenses, debit depreciation, credit accumulated depreciation. There's no cash related to that, so we're going to add it back to our income and our operating activities. But then for things like losses, same thing, decreases in current assets. If assets decrease, right? So if we reduced our inventory, it means we sold it. So that would increase our cash flow. And then if we increased our current liabilities, it means we received cash. So if we increased our accounts payable, it means we didn't pay cash for it. And so that would be increased to our current liabilities. So that's the thought there. I know this part of accounting can get rather tricky because we are going and reversing everything we did through the entirety of our accounting course. So just try to understand, try to memorize this first off, and then try to understand why. If you can understand why these differences occur or why this math exists, then you're going to really accelerate your accounting knowledge. And we'll try to dig into that more. But there's a lot to cover here still, so I can't spend too much time on it, but we'll go over it for questions. If inventory went up, we're always going to see the difference. Assets are inventory. It went up by 20, right? This year it's 100. Last year it was 80. It goes up by 20. We'd ask ourselves, was this an inflow or outflow of cash? And so we ask ourselves, if we increased our inventory, did we pay cash for it? And the idea is, yes, we probably paid cash for it. This would be considered an outflow, and we reduce it from our net income in the statement of cash flows. And so this is the kind of logic we would use for every single line item. And this is stuff I use this kind of logic for the work I do today. Right? I use this on every day on the job. Liabilities, accounts payable. If our liabilities went up by 100, up by 20, they went up from 80 to 100. That's an increase. Is that an inflow or outflow? Well, if we think about it, accounts payable, we debit our expense, credit our accounts payable. Well, we really didn't pay any cash there. We got away with not paying cash, right? Which is good for our cash flow. We'll consider that an inflow and add it back to our statement of cash flows. If we decreased our inventory, so if we had $100 in inventory last year and now it's 80, we're assuming we sold $20 in inventory. That's an inflow or increase, right, in inventory. So we're going to add it to the statement of cash flows and operating activities. Accounts payable, if it decreases, that means we paid that accounts payable, right? We debit the accounts payable and we credit cash. So we're going to decrease or subtract it from the statement of cash flows. And we can go down that for every single line item. So we can ask ourselves here, these are the kind of questions you'll get on the exam. We can ask ourselves, East reports $125,000 in income for the year. And if accounts receivables increased by $7,500 during the year, and accounts payable increased by $10,000, and we had $12,500 in depreciation, what's our operating cash flow? And so I'm not going to ask the class to do this yet. We'll just go through this example. This is the kind of thing I would expect to test you on. We start with our net income, right? Why are we starting with our net income? We're using the indirect method. And we're using the indirect method because it's easy, right? And because that's the information we have available. And so we're always going to start with our net income. And then we're going to reconcile it to get our cash flow of operating activities. So net income, $125,000. And the next thing we're going to do is add back non-cash expenses. What's a non-cash expense here? The depreciation expense. We don't pay cash for depreciation. It's just a reduction to our assets over a long-term period. So that depreciation, right, is normally debit depreciation, credit accumulated depreciation. And so we need to add that back to our income because we actually didn't pay cash for it. So we'll add depreciation expense. So our net income now plus $12,500. Then we'll look at the next transaction. Accounts receivable increased by $7,500. Well, if our accounts receivable increased, did we receive cash for it? And the answer there is no, right? We debit accounts receivable, credit revenue. So that's increasing revenue without receiving cash. And so we're going to deduct the increase in accounts receivable. Other way to think of that is the memorization, right? We're always going to subtract increases in current asset from net income, and decreases we're going to add back. Two ways to think of it. And the last piece is the increase in accounts payable. If we increased our accounts payable, we're going to add that to our cash flows because we have expense. That expense lowered our net income, but we didn't actually pay cash for it. So we're going to increase it back up because it's a debit to expense, credit to accounts payable. There's no cash related to this, even though it decreased our net income. So we're going to add that back. And so our ending operating activities, cash provided by operating activities is $140,000. And none of this is intuitive, but it makes sense if you think about it. If our payable goes up, are we paying cash? We owe cash in the future, but are we paying cash now? And if you think about it that way, we aren't. It's actually good for us to increase our payables from a cash flow perspective, right? Because we don't have to pay cash now, we get to pay cash later. What's something I've said almost every single lecture is, if I can teach you guys anything about business, it's first thing is get customers and make money. Make money as soon as you can to prove out your product and to prove that you actually have a business. Until you're making money, most of the time you don't have a business unless you're something like a pharmaceutical company. First thing is make money. The second thing is manage your cash flow. Always try to collect your receivables as quickly as possible and pay your liabilities as late as possible. And most companies do that. Most companies are going to do their best to pay their liabilities as late as they possibly can and to accelerate their cash flows. That's a whole job of a treasury department in a company. It's managing cash flow. And so if we can increase our payables, so if we owe money and we can increase our payables, but we haven't paid it yet, that's a benefit to the company. And we'd actually add it back, because in net income, take in mind, this net income is treating this accounts payable as an expense, right? But in reality, and from a cash statement, cash flow viewpoint, we haven't paid that yet. So it would be logical to add this back to the net income. I strongly encourage everyone, practice your homework on this. Go over these slides, memorize this table. If you understand the logic, even if you understand the logic, memorize this table. Memorize that if you increase your current assets, it's a subtraction from net income when we're reconciling operating activities. If we increase our current liabilities, it's an increase to net income on the cash from a cash flow perspective. And by the same with the decreases, just memorize this table and also understand the logic for your exam. Also just memorize these transactions. So simple recap, I'd flashcard this one. To get operating activities through the indirect method, net income, non-cash expense, such as depreciation and amortization, we add it back. We add back losses and subtract gains that are non-cash. And then plus or minus for non-cash current assets and current liabilities will equal our cash flows from operating activities. That's everything we just did. Only thing I would add here is if we had a loss from a sale, we'd add it back to income. If we had a gain from a sale, we'd subtract it, because it doesn't relate to the income doesn't relate to the cash we've received. And then I'd memorize this table.